Hi everyone, this is Doug Brennicke. In this installment, let's talk a little bit about rate locks. At the beginning, when a person applies for a loan, there's a little bit of a process that we take a look at to see if they're, in a sense, qualified for being able to get what they're asking for. It's kind of a pre-qualification process to see whether their income looks substantial enough, whether their employment looks stable enough, whether their credit history looks fine. Of course, at this point, we don't have any idea about the appraised value or the condition of the property, although we can ask questions to get a pretty good sense of it. We won't know for sure. But the buyer is interested in taking a look at how they can protect themselves against future rate increases. And so the institution of something known as a rate lock is something that the lender is in a position to provide. Now, the terms of rate locks vary anywhere maybe from 15 days to 30 days to 45 days to 60 days. Longer rate locks may be available, but there's usually an extra cost for those longer rate locks because the lender's being asked to make a guarantee on a rate farther out into the future where it's tougher to predict. The important thing about the rate lock is that we do want to match up the term of the escrow or the proposed closing period with the amount of time that we put on the rate lock. So let's say, for example, a buyer and a seller agreed to a 50-day escrow, and that on day one, the loan application is created and the borrower wants us to lock in their interest rate. It would do no good whatsoever for me to lock it for 30 days or 45 days if the proposed closing date is 50 days away. We would have to entertain the 60-day rate lock category to provide the kind of protection that the buyer is looking for. There's no purpose served for having that rate lock expire on day 45 when he's trying to close on day 50. So that's the first part of the equation, is to determine the length of time and make sure that the length of time for the rate lock is sufficient to allow for the closing of the transaction. Then beyond that, a fair amount of the quote that comes out for the interest rate for the borrower is going to be based on the amount of the loan that they're requesting in relation to the value of the property. We call this a loan to value ratio. If it's 80% or less, typically the better terms are being quoted. If it's higher than 80%, meaning that the down payment is less than it would be with 20% down, then typically the rate quotes are a little bit higher because there's higher risk associated with that. Their credit score is also going to be an important component. Somebody with a 740 credit score is going to get a better quote than somebody with a 720 or a 700 or a 680 credit score. Again, it ties into what the projected risk is on the loan in relation to what the borrower is asking for. So if you have a situation where you have somebody with very little down payment and a very low credit score, the quote that they get is going to be largely different than somebody with a high credit score and a low loan in relation to the value. But locking in the interest rate at inception is a way that a borrower can be feeling comfortable that they're not going to have a surprise occur for them at the last minute, with the emphasis being on that the rate lock term is sufficient to cover the closing period of the escrow. So hopefully that gives you a little bit more insight into rates and rate locking, and we'll have another installment shortly. Thank you.